You want to see price move aggressively into your predetermined trade zone, creating a huge imbalance in price delivery. Then you want to see a new bullish ABCD swing formation. You want to see price break the D point and close above it to confirm the reversal. Your entry order should be set on the demand zone created before the break of the D point. What's up guys, how are you all doing and how has been your trading? Hope you're catching pips and growing that equity curve. To my Tom's Capital family members, you're welcome to today's video. If you are seeing my video and channel for the very first time, you're welcome. On this channel, we give out great information and educational content on trading with facts and institutional data, thereby helping our members to see the market with the eyes of a true smart money trader. If this sounds like something you want for yourself, don't hesitate to join the family by subscribing to the channel and turning on post notification. Do it right now, it's absolutely free of charge. In this video, I'll be sharing with you the 5 ultimate reversal patterns that I use for all my trades. It's either one of these patterns or no entry for me. Please note that reversal patterns are for confirmation and entry timing purposes only. Determination of directional bias, trade zones, and institutional price should be done using institutional data, contract analysis, and economic data analysis. If institutional and contract analysis sound alien to you, then you need to see our video on how to overcome the Forex time frame scam right after this one. When you are looking to take a trade, as soon as you have price in your predetermined price zone to trade, then you wait for any one of these reversal patterns to print on intraday charts such as 5 minutes time frame or the 15 minutes time frame. Then you are ready to set your pending order. If you are scared of pending orders and still have to wait so as to manually click your trades open, that means you don't trust your analysis. If you fall in that category, I'll advise you to stick to this Tom's Capital family more, because the information in our videos will definitely show you the reality of the market that you can research more on and eventually build confidence in your analysis. Without further ado, let's jump right into the reversal patterns. The first and foremost of our ultimate price action reversal patterns is what I call common reversal. In a bullish condition, these are the steps you need to see to confirm a common reversal. First and foremost, you want to see price trend into your predetermined trade zone with a series of lower lows and lower highs. Then you want to see a bullish break of structure creating a higher high with a higher close candle. This break of structure must come directly from the previous lower low created in your trade zone. Once you have this, your reversal is confirmed. Then you want to set your entry. Your entry order should be set on the demand zone created before the break of structure. Let's take this illustration for example. This swing created a demand zone here before the push that broke structure. Therefore, the pending buy order should be set on this demand zone right here, and stop loss should be few pips below the low. Target should be based on institutional liquidity, retail liquidity, or contract highs. Opposite of all this is true for a sell trade. Let's go right into the chart and see what a common reversal looks like with candlesticks. Here we have a 5-minute chart of the Euro USD with 1.0245 price as our predetermined sell trade zone lower price. Let's assume this rectangle represents the trade zone. Price hit the zone right here with this trend series of higher highs and higher lows. Price broke structure right here by breaking and closing below this last higher low right here. That completes the common reversal pattern. The next step is to set our entry order. This last bullish candle before the break of structure is the supply zone that created the break of structure. Entry will be on this zone and stop loss will be at few pips from this high. The order will have been activated right here and the bearish move followed. Still on the 5-minute Euro USD chart, here we have 1.02515 price as our predetermined sell zone with this rectangle representing the zone. Price hit the zone right here with this higher high, followed by the break of structure by this candle that breaks and closes below the higher low to complete the common reversal setup. This last bullish candle here is the last bullish candle before the break of structure, which makes it the supply zone and entry zone for our sell order. So sell order will be here with stop loss few pips from this high. The order was activated here and price dropped from there. But price came back to run the first entry right here. Although it didn't get to stop loss. The reason for this liquidity run here is because this is a new day and new daily contracts were opened. This line right here marks the beginning of a new day. That is why it is not advisable to open new trades towards the end of the day. It's far better to wait for that day to close and open your trade the following day. The second reversal pattern is what we term hidden reversal. This type of reversal is commonly used when the move that takes price to your entry zone is caused by a news event. So the first thing you want to see to look out for a hidden reversal pattern is that aggressive move caused by news events. You want to see price move aggressively into your predetermined trade zone, creating a huge imbalance in price delivery. Then you want to see a new bullish ABCD swing formation. Please note that the D point of that ABCD swing formation must be equal or higher than the B point. After this, you want to see price break the D point and close above it to confirm the reversal. For the reversal pattern to be valid, the whole reversal price action must not completely close the imbalance created by the impulsive move into the entry zone. Your entry order should be set on the demand zone created before the break of the D point. If you put a trend line on the ABCD swing like this, your entry will be behind the trend line, and this setup is trading against flag traders. They sell, you buy from them, just like the institutions. Stop loss should be placed few pips from the original low, and your target should be set as in the first reversal pattern type. In a bearish condition, all this is reversed. Let's look at some examples on the chart with candlesticks. Here we have a 15-minute chart of the Euro USD with 1.015 price as our predetermined buy trade zone higher price. Let's assume this rectangle represents the trade zone. Price hit the zone right here with this impulsive drop, most likely caused by a news event. The drop created this massive imbalance in price delivery, which makes it a potential hidden reversal opportunity. Price gave us the reversal ABCD swing with the D point right here. Then price broke the D point right here, completing the hidden reversal setup. Remember, there is one more condition for this to be valid, which is that the break of the D point must not completely close the imbalance created by the impulsive move. Does this setup meet that criterion? Let's check. The imbalance price action started from here, and the high of the breakout is here, meaning we still have this imbalance left. That makes this a valid hidden reversal setup. This bearish candle is the demand that led to the breakout, which makes it the entry point. So entry will be here and stop loss will be few pips from this low. The order was activated right here and price took off from there. Here is a second example of the hidden reversal on a 5-minute chart of USD CAD. We have 1.2950 as our predetermined sell zone lower price. Let's assume this rectangle is our sell zone. Price hit the zone right here with this impulsive bullish move, creating this imbalance price action. We got our ABCD reversal swing from the sell zone with this D point right here. The D point was broken here. The low of the breakout move did not completely close the imbalance in price delivery, which makes this a valid hidden reversal setup. The supply that led to the break of the D point is here, which makes it our entry zone. Entry will be right here and stop loss will be right here. Just like in the previous intraday example, price came back up to run our entry right here before the drop, because of the new daily contract being opened. So the importance of not opening a new trade towards the close of the day cannot be overemphasized. The best way to enter this type of intraday entries is to set your order at the IBDA price above the initial supply zone. Or better still, wait for the liquidity run and then find new entry there with a tighter stop loss range, something like this. The third reversal pattern is the liquidity pool reversal. If you are an old member of the Thumbs Capital family, you will know the basis of this reversal pattern as I have explained it in great details in our liquidity video. If you are yet to see that video, make sure you watch it immediately after this one for a better understanding. And if you are yet to subscribe to the channel, take a moment to do that right now. Smash the subscribe button, turn on post notification bell so that you don't miss out on our videos. In a bullish scenario, the first step of a liquidity reversal pattern is that price fails to make a lower low on reaching your trade zone, thereby creating relatively equal lows, or what is commonly referred to as double bottom or triple bottom. After this, price runs the lows created to grab liquidity. Your entry should be done inside the liquidity run based on lower time frame reversal pattern, which is one of these 5 reversal patterns but on a smaller time frame. Personally, I use the 1 minute time frame. You can use the 30 seconds time frame or even 15 seconds time frame. If you miss the entry inside the liquidity run or price rejects so fast that the 1 minute time frame fails to print any reversal pattern, your entry will be on the retest of the relatively equal lows. I'll advise you add a few pips for clearance so as not to miss the trade by 1 pip or 2 pips, which can be very painful. If you are getting value from this video, please give it a thumbs up right now and also drop your opinions and questions in the comment section. I take time to respond to comments. Now let's look at some example of liquidity pool reversals on the chart. This is a pound USD 5-minute chart. Here we have 1.219 as the predetermined sell zone lower price. Let's assume this rectangle is a sell zone. As price approaches the zone, it slowed down and created this relative equal highs, one here and the other right here. This is a liquidity pool, as you can tell from the knowledge from our past video on liquidity and liquidity pools. Price ran the liquidity pool right here to hit the sell zone. Entry will be right here inside the liquidity run using lower time frame reversal pattern for confirmation. Entry will be in here and stop loss will be few pips from this high. If you miss the entry in the liquidity run, the second entry will be at the retest of the equal high right here. Here we have a second example on the USD CAD 5-minute chart with 1.29 as our sell zone lower price. Let's assume this rectangle marks the sell zone. Similar to the previous example, we have these relative equal highs here, which are liquidity zones, and in combination makes a liquidity pool. Price ran the liquidity pool right here to complete the liquidity pool reversal setup. Entry will be inside the liquidity run using lower time frame reversal pattern for confirmation. So entry will be inside here, stop loss will be few pips from this high, and as you can see, the sell happened straight away without presenting the second entry opportunity. The fourth reversal pattern is the batch liquidity reversal. This is similar to the liquidity pool reversal that runs multiple liquidities at the same time. The difference in this case is that the liquidity runs are done in batches. I explained more on this in the liquidity video. If you haven't seen the video, you need to watch it right after this one. In a bullish trade setup, the first step of a batch liquidity reversal pattern is that price hits or gets close to your trade zone, after which a bullish ABCD swing is created without breaking structure. Price runs the A liquidity zone and immediately creates a new ABCD swing liquidity on rejection from the first liquidity run. After this, price runs the new liquidity to complete the reversal pattern. Your entry should be done inside the second liquidity run based on lower time frame reversal pattern. If you miss the entry inside the liquidity run, your second opportunity will be on the retest of the first ABCD swing low. And just as in the liquidity pool reversal, always add a few pips for clearance so you don't miss out by 1 or 2 pips. Now let's see what the batch liquidity reversal looks like on the chart. Here we have the 5-minute chart of the Euro USD with 1.0125 as the predetermined buy price. Let's assume that the buy zone is this rectangle. As price approaches the zone, it slowed down and created a liquidity zone right here, which was taken out here, and immediately that was taken out, a new liquidity zone was created right here. The second liquidity zone was taken out here inside the buy zone to complete the batch liquidity reversal. Trade entries should be done inside the second liquidity run using lower time frame reversal pattern. So entry will be in here and stop loss will be just below this low. If you miss that, the second entry opportunity is on the retest of the first liquidity zone, which is right here. Stop loss will still be at the original low right here. All the trades were activated and price rallied right away. This is a second example on the batch liquidity reversal on the 5-minute chart of Euro USD with 1.028 as the predetermined reversal price or buy zone. Let's mark the buy zone with a rectangle. Just like the previous example, price on the way to the buy zone created a liquidity zone right here, which was taken out right here, after which a new liquidity zone was created here, which was then taken out by this final push into the buy zone to complete the batch reversal pattern. Entries should be inside the second liquidity run using lower time frame reversal pattern for confirmation. So entry will be in here and stop loss will be few pips below the low. A second entry opportunity is supposed to be the low of the first liquidity zone, but in this case price never came back there. But you would have gotten in right here if you missed the first entry. If you miss this and miss the second entry also, then you should forget the trade and accept your fault for being absent. The fifth and last of our ultimate price action reversal patterns is the Vertex trap reversal. This reversal pattern is used to confuse breakout traders and flag traders into going the wrong direction. In addition to that, it denies them the opportunity to join the trade after realizing they are wrong. In a bullish trade setup, the first step of a Vertex trap reversal pattern is that price creates a narrow range close to your trade zone. This is followed by an impulsive breakout of the range to hit your trade zone. Price immediately and quickly corrects the impulsive move and returns into the narrow range. The next step after this is that price creates a new narrow range just opposite the initial range. Please note that the second range doesn't have to align perfectly with the first one or have the same price range. That is, the second range may be slightly wider or thinner than the first range. This completes the Vertex trap reversal pattern. There are two entry models for this reversal pattern. The first one is the aggressive entry, which will be at the lower boundary of the range, whereas a more conservative entry will be at the bullish breakout and retest of the second range. This pattern is similar to the liquidity pool reversal, but with a more aggressive breakout that most traders will not class as liquidity run. Let's take a look at some examples of the Vertex trap reversal pattern on the chart. Here is a 15-minute chart of the Euro USD with 0.998 as our predetermined buy price. Let's assume this rectangle marks the buy zone. Just before hitting the buy zone, price created this range right here. The range was broken right here with this heavy breakout push that hits the buy zone. At this point, flag traders and breakout traders are so confident that it is a sell. Immediately after the impulsive breakout, price recovered and returned into the zone. See how this hanging man candle right here with long wick was formed at the retest of the range just to lure retail traders in to enter the sell trade. Following that, a new range was created right here, which completes the Vertex trap reversal pattern. An aggressive entry will be right here at the lower boundary of the range with stop loss few pips away from the boundary. The stop loss can be set using IBDA price for safety, and the second entry or conservative entry will be at the break and retest of the channel right here. Stop loss will still be few pips away from the lower boundary. There you have it, the 5 ultimate reversal patterns that will help you catch 99% of reversals in the market. We have come to the end of this video. Don't forget to like and share the video with other traders to help their trading journey. Subscribe to the channel if you are yet to subscribe. If you have any question, leave it in the comment section or DM me on Instagram at ThompsCapital. I'll try to answer as many as I can. I'll see you on the next video. Happy trading, guys.